real estate, Las Vegas. Two concepts that in some manner mirror each other very well, go very well together, both in very high demand. And if you look at hotel prices, there are suggestions of short supply, that even though we have more hotel rooms in Las Vegas than any other city in the entire country, hotel prices have gone up over the past couple years because we still do not have enough hotels. And so we've got the Fontainebleau, which is supposed to open at the end of this year. We've got the Durango Resort Casino and Spa, which will open in the fourth quarter of this year. We've got different construction to try to alleviate some of that shortage of supply. Except we don't have a whole lot of that in real estate. So let's go ahead and start paying attention to what some of the numbers are. I am Justin Miller with the Chong Miller Group. At the Chong Miller Group, we help people build wealth through real estate. We help people buy and sell homes. Every month I do a market update. This is the August 2023 market update, wherein we look at resale single family residential real estate here in the Las Vegas Valley. We look at that for the month prior. So we're looking at July of 2023 and we're making monthly comparisons. So June to July, what was the trend, what was going on, and annual comparisons, July of 2022 to July of 2023. So we can see what's sort of transpired over the year, and we can eliminate some of the seasonal fluctuation that happens across the calendar, because we know when it's super hot, there may be less activity. When it's super cold, there may be less activity. So we want to try to eliminate that seasonal fluctuation. Of course, we have fluctuation that attaches to the data based on other cyclical patterns of business cycle, pandemic opening cycle, etc. They can sometimes throw those annual comparisons way off, so they become a little bit deceptive. Right now, we're kind of sitting in an interesting sweet spot because in 2022, we were transitioning at this time from a very hot part of the last upcycle to really starting to slow down. And I've been suggesting our annual comparisons are going to start to look quite more favorable where they had looked bad in the beginning of the year. We're going to see that as we look through this month's data. And we're going to continue to see it as we look through the monthly data every month of the remainder of this year. All right, so let's go ahead and dive right in. So the first piece of data I want to look at is pricing. How did pricing do? Sometimes people focus a little bit too much on this number, but it's an important number. It's a good market indicator. Of course, there are others that we look at as we go through the monthly videos. But price for the end of July of 2023, $447,500. That's up $7,500 from the end of June when we were at $440,000. Now, interestingly, we are down 3.8% from the 465 that we had in July of last year. That means over the past year, we've fallen 3.8%. That's not very much of a decline in prices. In fact, in normal years, if we were looking at gains of 3.8, we would say that's close to on par. If we're looking at losses of 3.8, we might say that's more than we would expect in a normal year, but we're not actually down all that far right now. Now, something interesting about these numbers, though, at $447,500, we're actually exactly halfway between the May peak and the November and January bottom of the last cycle in the market. So in May of 2022, we peaked at $480,000. We had gone down to, in November, bounced slightly, and then in January of 2023, we were at $415,000. So we had dropped $65,000 during that time, about 12%. We've recovered exactly half of that. We are up $32,500 from the bottom of the market. We're down $32,500 from the peak of the market. So kind of interesting what we're seeing here. We've just transitioned from being down more than the recovery. We're now sitting halfway recovered back to the peak. There's a real possibility we'll actually get by the end of the year to the previous peak. I don't think we're quite going to exceed that, but we should be something within a couple $1,000s of the previous peak by the end of the year, I would think. Now, this is interesting because last year in November, as I was doing my 2023 market forecast video, I was predicting that what we were going to see was some stabilization in quarter two, after having seen continuation of a little bit of downtrend in quarter one. And once we got to quarter three, we're going to see prices headed back up. Not to achieve the previous peak, but rather headed back up from where they had settled, and we would then be moving forward from there. Well, I've mentioned a couple times over those past several months that I actually was probably about 2 months late in the forecast for where things were going to turn. And so we actually saw stabilization coming into the market in the middle of quarter one. Continuing into quarter two, we saw prices start to go up in quarter two. And here we are with July's data, the first month of quarter three. And we've now fully recovered 1/2 of the entire drawdown that we saw in prices last year. So that's actually really interesting and really encouraging. And quite frankly, a much quicker turnaround than most people were suggesting. Most people doing their YouTube videos or writing in the newspapers or doing their podcasts had been suggesting late last year that we were going to be in the midst of a long-term big crash this year. My forecast turned out to be spot on. I just simply was maybe 2 months late in where I forecast that turn in the market was going to occur. So I want to point that out to you. It's a pretty significant thing. Okay, now one other way I look at pricing is price per foot. Price per foot for $243. That's up from $241, or up 0.8%. In July, that is down 6.9% from the $261 per foot that we saw in July of 2022. Now, this is interesting because it means month over month we're up 0.8% on price per foot, but we're up 1.7% on that median sale price. We're down 6.9% year over year on price per foot, but we're down only 3.8% on the median sale price. This suggests we're seeing a continuation of what became really apparent over the past 2 months, which is the middle portion of the market is what's recovering the fastest. And we've got some level of continued dislocation in the top part of the market. So top portion of the market, sales are slower. That's pulling median price per foot lower. And the middle of the market is quite strong, which is pushing up median sale price. So we're still seeing that little bit of divergence in the market where the middle is strong, the top end is a little bit weaker. And so it's kind of an interesting thing to note. Okay, so that's pricing. Pricing is looking pretty decent, pretty good. We are down year over year, but you'll remember at the beginning of 2022, we saw that sort of acceleration in the uptrend in pricing. But I had cautioned in the first half of 2022 with that acceleration, what we were actually seeing was some narrowing of the market, that things were stronger at the top of the market where people were less interest rate exposed because they might be able to pay cash. Something like that. So we saw a little too much appreciation in the first half of 2022. We saw a little too much depreciation perhaps in the second half of 2022. Right now we have a really strong middle of the market, which is accelerating, pushing prices higher. but we're seeing it's middle of the market in terms of price per foot. So it's actually a really encouraging statistic. We're not blowing out on the top end and leaving everyone else behind. There's not really much of a bottom end of the market right now. The bottom quartile, if you will, has collapsed to be so small in terms of price gap between the bottom quartile and the middle half of the market that there's not really a great reason to bother thinking about that bottom quartile statistically right now. It exists, but we're sort of looking at the 0 to 75% strata relative to the top quadrant of the market. Now, what about number of sales, number of closed sales that took place in July of 2023? Now, this number is going to be a little bit disappointing, and I want to talk about why, but we had 1,870 closed single-family resale transactions in the Las Vegas Valley in July of 2023. That's down. It's down 10.4% from 2,087 that took place in June of 2023. It's also down 27.7% from the 2,586 that took place in July of last year. Remember, last year, as we were going through the third quarter, we started seeing sales drop precipitously. And so that number, we're going to start to see really big changes on the annual comparison over the next month or two. But we're down relative to June. Why is that? Well, you may remember, if you go back, you look at the May and June video, interest rates had started spiking higher again in the mortgage-backed securities market. And so in May, we were seeing interest rates come in right just about 7%. Through June, we saw interest rates come down to about 6.8, 6.75%. Well, in July, we've actually seen interest rates back up again to just over 7%. We've seen continued resistance of buyers when we get to interest rates that exceed 6.75%. Now, I want to point out where we were in 2001 at this time of year. We were sitting at interest rates that were about 3% for 30-year fixed rate mortgages. We've come up, and we were seeing last year in 2023 significant resistance by buyers anytime interest rates were spiking over 6. We've seen a settling of the buyer market to recognize value still, even when mortgage interest rates were at 6.75% and below. And so that's what we're seeing sort of in March, April, in fact, in February, March, April, somewhat in May, June. Well, July, we're sitting considerably higher than that. We're about 25, 28, 30 basis points higher, so 0.25, 0.3% higher on a mortgage. And that makes a significant difference in the monthly payment for the same purchase priced property. And so that's going to take buyers some additional time to adjust to. Now, I will say, if we look at 10-year treasuries, where historically 30-year mortgage rates are about 196 basis points, or just less than 2% higher than 10-year treasury notes, we're higher. We've been higher than that 196 basis point spread for a couple of years now. We keep trending back toward it, and then we spike higher every time the Federal Reserve makes one of these strong moves. Well, the Federal Reserve made a strong move at the end of June, and that caused interest rates to spike higher. In fact, even the 10-year Treasury has spiked from about 3.94% to about 4.15%. So that was a 20 basis point move higher, and that's caused the 30-year mortgage-backed securities market to jump higher by about 75 basis points. So the jump is too big, it'll settle back down. But while we're sitting here around 7%, expect some level of buyer resistance. And so we're seeing that demand number moderating a little bit. We're seeing it specifically sitting in the sales number, right? So 1,870 sold, down 10.4% from the prior month. Now, something else happens with high interest rates. A lot of people have been out there talking about how terrible these interest rates are, and it's causing all sorts of foreclosures. And so I don't really look at the foreclosure data. It's qualitatively different in terms of what it means to go through a foreclosure than what it means to be a typical resale. But just to give you some perspective about the scary sounding stuff out there where foreclosures have doubled and et cetera, the number of completed foreclosures that took place in July of 2023 in the Las Vegas Valley, 15. Right? There's no foreclosure wave happening. There's no tax sale wave happening. It's all illusory. It's simply statistically, it's a lot higher than the 1 or 2 that we were having per month when foreclosures were effectively banned because of law protecting homeowners from foreclosure during the pandemic closing. That number's come up from the 1 or 2 per month. It's come up really significantly. It's gone up by a factor of 10, right? It's almost an order of magnitude higher. It's still 15. So you can concentrate on being deceptive in producing statistics or being deceived by consuming statistics, or you can actually look and see, what do the statistics mean? They mean nothing except that there's very little foreclosure activity. And this is something I've been saying, not in this direct a manner, but over the past year and a half, we have owners, because of appreciation, who have so much equity in their property. Not every single owner, but the overwhelming majority of owners, that they are sitting on something that there's no way they're going to allow to be foreclosed on. They'll sell it first. And we're seeing very, very, very few distressed sales. We're not seeing short sales, right? The numbers of these things are really low. So the local economy is supporting the housing market. Owners in the housing market, they're not being forced into sales. They're certainly not being foreclosed on. And if you think you're going to wait around and get an amazing foreclosure deal, I don't know how long you're going to have to wait, but you're not going to get it in Las Vegas. Maybe you have to go to someplace like Detroit and do it there. And I don't know you'll even find it there. So let me point out one other demand-based number, and that is pending home sales. And every month I point out the number of pendings because those are contracts that are written that should be closing in the following month. We know that a number of those are coming back on market because of bad appraisals or other reasons, but the pendings, that's a number of buyers who have made a successful offer to a seller. In other words, it's a statement of demand. And most of the pending contracts are going to close. Every buyer who makes a pending contract with the seller, both parties are planning that transaction is going to close. So that represents demand in the marketplace. 1,927. Even with the spike in interest rates, that's up, not much, it's up 10 houses from 1,917, or 0.5% from the prior month from June. It's down 2.3% negligibly also from 1,972 pending contracts that were written in July of 2022. We're going to start to see that pending number come down on last year's statistics, so that'll be kind of interesting. That number is that comparison annually is going to flip next month in almost certainty. But pending contracts actually went up from the high level of pending contracts that we had last month. in June, and that was up actually from where we were in May, which was up from where we were in April, which was up from a very strong gain that we saw in March. So pendings are still going higher, even though the rate of increase on pendings has slowed, undoubtedly because of this interest rate spike. We're not seeing a drop off in pendings right now. We still see strong buyer activity. And again, that statistical analysis is supported by and supportive of the increasing prices that we're seeing in the marketplace. You don't get increasing prices without having some level of demand to absorb those prices, right? I don't present list prices to you. I'm presenting to you the closed contract price. So that means this is the price at which the transaction concluded. Buyer bought at these prices. All right, so that's the demand side of the picture. Let's look at the supply side of the picture. And I've been saying we were going to run into a problem. I've been saying we are running into a problem. And now finally you're starting to see headlines out there from others who are saying, oh wait, there's an inventory problem. Yes, there's an inventory problem. The number of houses for sale, single family resale, residential here in the Las Vegas Valley, at the end of July of 2023, 3,703. Very low number. And you can go back and check the videos that I've been doing over the years, and you'll see that in October of 2020, that's the first month I'd seen where that number of for sale units had gone below 5,000. Well, we've been below 5,000 for most of the time since October of 2020. So approaching 3 years, we got well above that for a few months in 2022, but we've been sitting on low inventory for quite a while. Well, in the low inventory number, this 3,703, this is just incredibly low inventory. We've been sitting at, we've seen numbers like this only a couple times over the past over the past 3 years. And actually, we've seen numbers like this only a couple of times over the past quarter century. These are really low numbers of inventory. This number, 3,703, is down 11.2% from the inventory that we ended June of 2023 with, 4,167. So we're still churning through this inventory. This is a continuation of a strong 9-month downtrend in inventory in the single family home space. In the multifamily video, I'll talk about townhomes and condos, but we're seeing that trend is stronger and longer in those segments as well. Inventory is disappearing from the market. Now, we're down a pretty staggering 47.2% from the 7,008 single family homes that were listed in July or on the market in July of 2022. Another comparison point, we're down 61.9% from the peak in inventory that we had put in last year in September. We had peaked in September at 9,723 single family homes sitting on the market looking to be sold. We're down 61.9% from that. There's some people saying, hey, we're down half on inventory, we're down a little more than half. This is a really big problem. And there are a lot of very experienced real estate agents in Las Vegas who'd been saying last year, oh, just wait for the spring, we'll get inventory build, because historically, every spring we get inventory build. And I was suggesting, no, that analysis was all wrong. Now, these were not the people who were saying doom and gloom. These are experienced real estate agents who are saying, we've seen this pattern before. We see this pattern all the time. This is an annual fluctuation. And I was saying, we're not going to get the same kind of return of inventory in the spring that we do every year. I was saying I thought we would pick up some inventory in May and June. Well, numbers for new listings, that's newly listed for sale product, in March And in April, the two historically seasonally strongest months of the year for getting new listings, they were down both those months. We fluctuated, we were down in May, we fluctuated close to baseline for June and July. Well, how do we look for, for May and June. How do we look for July? July of 2023, newly listed resale single family homes, 2,237. Down 10.6% from the number of newly listed resale single family homes that we saw in June of 2023, down from 2,503. Down almost 300 housing units of newly listed into the market. We're churning through inventory. We're not replacing the inventory with newly listed. We're down 50.0% from the new listed number that we saw in July of 2022. We're down from 4,475. We're down 50%. These numbers of new listings, as well as the overall inventory pool, these are at historically low levels, right? We get some level of fluctuation each month, but these are historically low numbers. These are not just like, oh, we've got low inventory. No, we've got incredibly low inventory. Stunningly negative news on the supply front, right? Demand, pretty strong, right? There's challenges in demand because of peaking interest rates, spiking interest rates, but pendings were flat, up very slightly. They were basically flat. Sales, yeah, they had come down, but not substantially, and prices had gone up. The demand side of this market is actually healthy. It's the supply side of this market that is under tremendous pressure. And we're going to continue to see this, right? There's no magic bullet. And anyone who's out there saying, oh, you know, things are going to be spiking higher on supply and prices are going to collapse, they're making it up, right? They're making it up because of whatever reason, but it's just simply false information. It is simply not true. I was watching a video a couple weeks ago. It was somebody who was saying, I found the problem in the market and why things haven't crashed yet. And it is associated with short-term rentals. And short-term rentals are going down in value because there are fewer short-term renters and they're paying less money. And that's going to flood the market with short-term rental properties being sold because those short-term rental landlords are losing money. Well, numerically, none of that actually makes sense. The data that particular person and then group of people who were requoting it was looking at was suspicious in and of itself, but the overall numbers can't cause any flooding of inventory into this market because those overall short-term rental numbers are too small, and not all short-term rental hosts are going to react in the same way at the same time and dump all of the short-term rentals into the market. So it's a silly analysis of problematic data. But I comment on it because that particular person doing that particular YouTube video literally said, and I quote, "If, like me, you want to see this crash, you should be hoping this is true." Stunning. You've got people out there even admitting what they're doing is they're hyping and cheerleading to try to induce a crash. It ain't happening. They're on the wrong side of the economy, and they're being, frankly, silly and stupid trying to scare people. And unfortunately, a lot of people have been scared, and there are a lot of people on the sale side as well as the buy side who pulled back from this market. And long term, they're probably harming themselves, but they're absolutely not benefiting themselves. The advice that's coming from these people who just simply want to be famous on YouTube, especially, oh, I was the one who forecast a crash, a terrible thing, dislocation in the market. They're dangerous people in the message of what they're delivering out there. be really careful. I'm not saying I'm the only person you should listen to. My track record is really strong. It is correct, and it is numerically, statistically, analytically correct, and you will benefit from listening to me. But if you want to listen to some other people, do so. Make sure you're validating all their information. Make sure you're taking everything they say with a full cup of salt water, because what they're saying is probably entertainment inducing fear. They're horror movie people saying these things, and you should treat them as horror movie stuff. Maybe ghosts are real, maybe ghosts are not real, but they tend not to stab you, with masks on in the middle of a hayfield or a barn with a lot of farm implement things that are going to fall on you, right? Those things are designed to scare you. Well, unfortunately, in our current environment, most of social media, it's only designed to scare you. All right. Two other things I want to talk about real quickly. The back on market. I've been highlighting this for a couple years now. Back on market remains very elevated in the single family home space. 711 contracts failed and came back into the market. That's 27.5% of contracts that had been written on single family resale houses collapsed. Over a quarter of the contracts collapsed. That is up slightly from May's 26.7. It kind of doesn't matter here if that number is fluctuating a little bit. It's been fluctuating from about 25 to about 30%. It is way elevated. That number exists every month, including in completely normal markets. That number in a normal market is between 10 and 15%. So we are still double back on market from what we should be. You want to make sure that you're talking to agents who can help protect you, whether you're a buyer or a seller, from that failed contract, from the things that induce a failed contract. So pay particular attention to that. Now, one other thing, and that is affordability. And this has been, it's been a little bit out of the press recently for reasons that I'm not entirely clear about, but it's been something that a lot of people harp on a lot is being a problem. Well, remember, for the past couple years, I've been looking at sort of where we were for affordability at the previous peak in June of 2006. And now we have a new cycle that clearly has been put in. So we have another peak that happened in May of 2022, right? And so we look at those, and we've got how much it costs to carry the median home at the average interest rate that was available at those two time periods. And then we can compare it to today. And of course, I use inflation adjusted numbers, so we're getting a more valid comparison than looking at numbers without taking into account the inflation. So in June of 2006, the median home at the average interest rate on a 90% loan to value 30-year fixed rate mortgage cost $2,595 a month to carry. In May, that home had gone up a little bit in value on an inflation adjusted basis. So the median home in May of 2022 at this last peak was $480,000. So it was a little more expensive on a dollar basis, but interest rates were lower. The average interest rate was 5.33%. And that meant that carrying that property, same kind of loan terms, $2,391, or about $204 less than it had cost in June of 2006. Well, what about the comparison to right now? Prices have come down. Remember, we were at 480 last May. We came all the way down to 415. We've recovered half of that, so we're sitting at 447,500 right now. On an inflation adjusted basis, actually, we're about $1,000 less than where we were at the peak in 2006. It's kind of interesting. It's random. It doesn't mean anything, but it's kind of interesting. That number on an inflation adjusted basis is about 448,500. So we're 447,500. But interest rates are a lot higher. Interest rates are 7.09% last week. So that's the number I'm using on the calculation here for the monthly carry cost. So $447,500 median home at the average interest rate of 7.09% on a 30-year fixed rate loan costs $2,676 a month to carry. Now that's just principal and interest, right? That does not include taxes, does not include insurance, does not include HOA fees, does not include special improvement or land improvement district fees if you have those. No master plan fees are in there. This is just mortgage and interest, mortgage principal and interest, $2,676. Now this is interesting because last year, as I was looking at these numbers, as we were coming down from the peak from June through December of 2022, I was commenting that our monthly carry cost was holding steady. We weren't seeing a collapse in prices. What we were seeing was the sales prices were coming down to allow for higher interest rates and actually stable monthly payment. So we were seeing buyers out there who were deciding, well, I can afford to pay it at this monthly level, and I just can afford to buy at this particular actual expense to maintain that same kind of monthly price. In 2023, we've seen that trend broken. We've seen it specifically broken in the middle of Q2, and we started seeing monthly carry costs go higher than what they were in May of 2022. And so that was kind of interesting. So now we've actually breached what we saw in June of 2006. So the monthly carry cost is now $285 a month more than what we saw at the peak price in this last cycle in May 2022, right? It now costs $285 per month more to carry that purchase at the new median price and the new average interest rate. We're up $81 per month from where we were in June of 2006. So this is really the first time that we've crested where we're on a carry basis in 2006. So this is really interesting, right? We're sitting at not a peak, we're sitting on an upward sloping trajectory of the real estate market that now has effectively 100% recovered everything you could possibly talk about from the pre-financial crisis peak that occurred in June of 2006. So housing prices are basically flat to where they were on an inflation adjusted basis. Carry costs are higher, and they're higher specifically because interest rates are higher. So when the Federal Reserve is engaged in this bizarre interest rate policy because of a misplaced desire to try to slow the economy to only see 2% inflation, which is historically aberrantly low inflation number. I don't know why the Fed got this tick in there wherever about this 2% inflation thing, but it's illusory. It's not real. It actually was 2% used to be considered the floor on inflation, because if you go below that, you run too much risk of accidentally throwing the economy into a deflationary cycle. Well, the Fed somehow has lost its way and decided 2% is now the cap on inflation, and they're trying to drive us down to 2% inflation. We're sitting at about 3.2% inflation, according to the estimates that were released just earlier this week. That is rather interesting because that's actually where the Fed target used to be prior to this bizarre group of Federal Reserve governors that we've got right now. It used to be desired inflation was 3%. And we're sitting right there at that line. And this group of Federal Reserve governors is attacking the economy. Where is this showing mostly? It's kind of interesting. In this last release earlier this week on inflation, where is inflation actually coming from? 90% of the inflationary force that was recognized in July in the US economy came from housing. That's rents and owner rents equivalent. It's not coming from food, it's not coming from gasoline, not coming from clothing, it's coming from housing. What the Federal Reserve is doing is they are causing the cost of money to go up so much that it's restricting the building of new housing, restricting the supply of new housing. It's actually causing some sellers of existing housing to pull out of the market because the interest rate differential between what they owe on their existing mortgage and what they would owe on a new mortgage is too great for them to be able to stomach. And so the Federal Reserve is literally harming the functioning of the housing market right now, nationally. Right? We have a lot of buyer demand. We're seeing it here. We don't have sales. We don't have supply. That's where we're seeing this harm. It's literally, as I've been saying for the past year and a half, with the Federal Reserve on this really problematic trajectory, all they're doing is they're causing the cost of production to go higher, which is reducing the level of production. That's what the Federal Reserve is doing, and that's what they seem to be continuing to do. That will continue to have some problematic effects on number of sales, but pricing is still going higher. And even sitting at these interest rates right now that we've got almost 7.1% on 30-year fixed rate loan, we still have plenty of demand in this market that supply is not being able to fully accommodate, causing prices to go higher. We're going to see that continue. Now, interest rates over this next month, mortgage interest rates, will start to settle back down. They'll come back down. I don't think we're going to see mortgage interest rates going higher than where we're at the end of last week. It's the 7.09%. I think that's about the top. Maybe it goes a tiny bit higher, but it'll keep settling back down every time, as we've seen over this past year and a half of Federal Reserve tightening activity. The Fed does something, mortgage rates spike, and then they head back down because the mortgage-backed securities market is profitable to attack those too high interest rates, and people get in and they're arbitraging what the Federal Reserve is doing. So we'll still see mortgage interest rates headed back down. The problem is right now, the floor under mortgage interest rates for a 30-year fixed rate loan has actually gotten to about 6.2%, where it had just a couple months ago been at about 5.95%. So we're not likely to see sub 6.25% mortgage interest rates until the Federal Reserve starts actually loosening monetary policy, which probably happens next year. So for those people who literally are concerned about affordability, we're going to see prices continue to go up, and we're going to see those people who have been priced out of the market because of high interest rates inducing higher carry costs. That's going to be hard. It's going to continue to be hard. And this is not actually great public policy, because while some people may like to rent, and there may be good things about renting, and there are good things about renting, one builds no wealth through being a renter. One can build very substantial wealth through being an owner, and the Federal Reserve's activity at this point in time is depriving a lot of people from the ability to become owners. And this isn't because their credit score is too low. This isn't because they don't have down payment money. This is because the Federal Reserve is manipulating the interest rate market specifically to try to slow the economy to get to problematically low inflation for no good reason other than they don't want to be seen as waffling on something. So anyhow, that's where we are. I am Justin Miller with the Chong Miller Group. At the Chong Miller Group, we help people buy and sell homes. If you find this kind of content helpful, useful, interesting, please subscribe, smash the like button, click the notification bell, and please share my content with friends or colleagues, neighbors, family members who you think could benefit from this type of knowledge and advice as they think about going into the market. I would love a chance to sit down with you to help you if you're a buyer or if you're a seller, try to figure out how to position yourself in this market and strategically align yourself with what's actually going on, and then come up with the tactics to find success in this market. I'll see you in the next video. Thank you.